Hey everyone, as I shared last week, three forces will shape the commercial real estate investment climate in 2026. I focused on job creation in my last video. This week, I'll focus on interest rates and debt capital availability. But before I go there, I need to dive into one of the key underlying drivers that will influence Federal Reserve rate policies: inflation. In 2025, the Fed kept rates elevated and their powder dry for most of the year. They feared inflation risk posed by the new tariff policies. And although inflation has crept up over the last year, it hasn't been the massive surge that many expected. Looking forward into 2026, most inflation forecasts remain relatively tame in the 3% range. Now, that's still above the Fed's 2% target, but it's nowhere near the breakout levels we experienced in 2022. So even though inflation remains elevated for some components of CPI, like services, housing, and some types of food, one key driver will likely restrain inflation in 2026, and that's housing costs. Housing makes up 44% of CPI inflation. It carries about the same weight as the next four largest subgroups combined. And the way housing inflation is measured tends to be backward-looking. Now, because home price appreciation was relatively subdued for much of last year, rising roughly 1.2% year over year through November, and apartment rent growth was also modest at about 3% nationally, it's likely that housing inflation, as it's measured by the Consumer Price Index, will continue to trend lower in 2026. As a result, because of the heavy weight placed on the housing component of inflation and its backward-looking nature, inflation will remain tame. Falling housing inflation will likely offset other inflation components and keep the headline CPI inflation metric near 3%. And if inflation remains relatively stable in that 3% range, then it'll free up the Fed to set a more dovish rate policy. In addition, Jerome Powell's term as the chairman of the Federal Reserve ends on May 15th, and the new chairperson will likely favor a lower interest rate climate. So while it's possible the Fed could cut rates by a quarter point at some point in the first 4 months of 2026, additional cuts later in the year are likely, potentially taking the overnight rate below 3% by the end of the year. And the widely held belief that the Federal Reserve will continue to reduce rates in 2026 could bolster commercial real estate debt liquidity, putting downward pressure on lender spreads. And that could ultimately lead to modestly lower interest rates for commercial real estate borrowers. Now, this isn't a done deal. A lot of commercial real estate lending is based on the 10-year Treasury, and the 10-year Treasury doesn't always track with the federal funds rate. Wall Street could view the risk climate differently, and the 10-year Treasury could end up moving higher over the course of the year. That said, since August of last year, the 10-year Treasury has largely remained range-bound between 4 and 4.25%. Regardless of how dovish the Federal Reserve is in 2026, financial markets still have a say in the cost of debt capital. Now, within that context, one of the other forces in play is the lender's perspective on commercial real estate and their willingness to lend. Since mid-2024, local and regional banks have been capturing a rising share of the lending market. And if that trend continues, debt liquidity will be boosted. In addition, Fannie Mae and Freddie Mac have increased their lending cap for 2026 by more than 20% to $88 billion each. And the Mortgage Bankers Association is predicting a 24% increase in commercial real estate lending this year. At the same time, the loan-to-value ratio for multifamily debt has been rising, while the LTV on commercial properties is showing some signs of upward pressure as well. All of this implies that the debt liquidity in 2026 will continue to strengthen, and commercial real estate borrowing rates will remain stable or potentially tick down modestly. And the positive lending climate will bolster commercial real estate transaction liquidity in 2026. Now, of course, there are risks to this outlook. Federal policies have been exceptionally unpredictable over the last year, and as we've seen in the past, financial markets can change very quickly. But barring a significant event or federal policy shift, the commercial real estate debt markets are looking increasingly accretive for commercial real estate investment. Nonetheless, investors will need to continue to monitor the markets and, as always, keep their eyes on the horizon.